Also with us is Joe Battipaglia, investment strategist at Stifel Nicolaus, whose equity research team, by the way, ranked #1 by the Wall Street Journal. Joe was once one of the biggest bulls in the market, but turned bearish in 2006 and stayed there until the first quarter of last year. So very good timing. Joe, let me ask where you are right now.
Well, we're very cautious. While on our balanced account we have a 70% allocation to equities, it's very narrowly focused on U.S. large-cap companies, and we're reading the tea leaves very carefully because we're concerned that we're not going to make a transition to the private sector carrying the weight of growth for the rest of this year into next year as the incentives and the supports are pulled away.
That's got to be a concern, though, because you want to see that obviously happen. Why aren't we going to make that sort of handoff, if you will? I mean, what's going wrong?
Well, what's going wrong is that the private sector is still contracting, pulling away from the demand for credit. The unemployment rate's extraordinarily high, and we're not generating the kinds of new jobs that can reabsorb all those folks. After all, the construction sector is in shambles. And now in the second half of the year, the government itself is probably going to lose jobs, not because the census is going away, but because states don't have balanced budgets at this point. They don't have money coming from Washington, so they're going to have to cut the headcount. This is counter-cyclical and dampens growth, and that's why GDP in the fourth quarter of last year might be the high watermark for this recovery, which means very sluggish growth. Yes, you get no change in interest rates. Yes, you get a threat of deflation, but not a strong recovery.
All right. Joe, let me ask you why you're not more bearish. I mean, given what you've just told us, that you're concerned about, there are no new jobs, state deficits are bad enough that they're going to start letting people go en masse. We're going to look at very sluggish growth going forward. And, Tony Crescenzi was out with a note the other day from PIMCO saying that since policymakers are basically out of ammo, there's really nothing they can do about it. Shouldn't this be a big concern?
Well, it is, and it's a matter of just what kind of expansion you end up with in the United States, because part of the drive here, of course, is that we have extraordinarily low interest rates and a Federal Reserve that looks to me, always err on the side of too much easing. So we expect no interest rate changes for a long time to come. That is a powerful stimulant for an economy, even one that's struggling to get back on its feet. Number two, the federal government is already committed to trillion-dollar deficits for the next several years. So there will be money coursing around the economy. We think it's inappropriately applied, but it's there nonetheless. And when you measure the economy across the credit marketplace and into the industrial complex, you do see the bounce back. You do see the inventory rebuilding. You do see follow-through demand. It's just more sluggish than most had hoped for. You are on a positive track here. Moving outside the United States, Japan and Europe are going to be disappointments in the next 12 months. They should have been carrying more of the load. They won't be able to for a variety of reasons. And then, of course, there's China, which is on a mission of its own, trying to dampen down the 10% growth rate, trying to curb the inflation. But their economy is relatively small in the scheme of things today, growing fast but small. So when you put this whole thing together, we have this concern about the ongoing outlook. If the U.S. were to falter in the coming months or next 6 to 12, these numbers would fade, and then the earnings story, which has been good to this point, would also fade, which means you need to become more defensive.
Joe, it's Dominic Chu here. One quick question. I've talked to a lot of advisors out there who said in times of stock volatility like this, they want to get paid to wait, and that, of course, means these large-cap dividend payers. Do you think that that's a safe haven now for people who want to be in equities but don't want that exposure to growth stocks, so to speak?
Well, there's two parts to that. First is, yes, those who are financially viable will continue to pay their dividends. In some cases, they'll be able to raise that dividend, and that's a good thing. On the other hand, if their earnings start to slow, and we go back into a recessionary environment looking out 12 or 24 months, then the valuation is going to be called into question. And so you've got a two-part answer there. So, yes, on a long-term basis, those companies that can sustain dividends in this kind of environment where disinflation or even deflation is the watch, then you're going to get a real rate of return on your investment. On the other hand, when you get to those recessionary turning points, valuations come in as well.
Hey, Joe, it's Adam Johnson. Let me jump in here, kind of following that theme about income. Yesterday, CEO of Hartford Financial with us, telling us he's got cash. He's using that cash to buy corporate bonds. How do you feel about corporate bonds as an asset class right now?
We happen to like them. We have them in our diversified portfolio, and we have them on the basis that we want the credit quality to be strong and getting stronger in a difficult environment. So on the margin, the high yield universe does not pay us well enough for the risk. They've had an explosive rally. We've pulled away from that. But corporates fit into this pattern well. In fact, we have just designed a portfolio of a 10-year ladder that we're offering to our clients that allows them to be in the investment grade category over a 10-year period of time, where we can get a strong cash return on our investment and always focus on the credit quality to maintain the purity of that portfolio. We think that can work in the environment we see ahead.
Hey, Joe, I want to get back to equities, though. I mean, at some point, even if your outlook is a little bit gray, things must just be so cheap that you want to get into them, especially for buy and hold investors, right? I mean, at a 13 PE, don't things look cheap in the equity market to you?
Right. Many have decided to compare that to the Treasury yield and conclude that the earnings yield, which is the inverse of the PE, makes stocks extraordinarily attractive. Unfortunately, we're in a period of time where the Federal Reserve has moved interest rates to extraordinarily low levels that are not sustainable. They've told the federal government that their policy decisions on a long-run basis with deficit spending are not sustainable. So some point in time down the road, there could be a clash of these. And that's why we can't use the conventional measure. So right now,
no rule of 20 here.
Yeah, the great enthusiasm is that earnings have rebounded so well despite the recession and this tepid recovery, and that's a reason to buy stocks. But if you question the theory that these earnings are sustainable, that they are indeed not necessarily sustainable, and we're at risk of subpar growth here, and you cut those estimates, now the multiple goes higher, not lower. And since the dividend yield on the S&P 500 is hugging the line towards 2%, it's not an explosively strong, compelling reason to go equities per se.
Hey,